All right, investors. This time, let's try to find interesting stocks. As you know, a lot of stocks from the larger cap currently look overvalued based on the DCF valuation, and I expect slight stock market correction, but maybe within 2 weeks. Um, so now let's try finding interesting stocks, maybe from a mid cap or from the smaller cap league. For this, we will be using the Google Sheets, and then when we find those stocks, let's see their fundamentals. Let's do really quick express analysis to answer the question, is it worth buying? Is it worth paying attention to those stocks? Well, not buying. Maybe if you find attractive shares, then you can undertake equity valuation and then you can start researching, dive deeper. But first, you need to answer the question, is it worth spending time on analyzing some shares? Maybe not. And that's why first we're gonna filter stocks, find attractive shares, and then you can proceed with further analysis, whether DCF model or DDM equity valuation model, and then understand if you should buy the selected stock and what growth potential it has. But the first stage is stock filtering, stock selection, and in this video, let's see how you can choose interesting shares. Well, first we will be using Google Sheets and Financial Modeling Prep add-on that you can connect to Google Sheets. I'll place the instructions down to this video. You also need to obtain your custom API key from Financial Modeling Prep. After doing that, you need to construct the stock screener yourself. In Google Sheets, simply go click on empty cell and use the formula, which is FMP stock screener. The formula is here equals FMP stock screener. Then inside here, you input the parameters. Limit is the number of data to be fetched. As you can see in my example, I have 10. So I am extracting 10 stocks for the screener. You can put 100, then it will extract 100 stocks, but this can be a large list. I just want to extract top 10 shares. Then this one is exchange. As you can see, these are valuable hints. In this case, I am extracting shares only from one exchange, but if you want, you can see the list of available exchanges. It's over here. You can input them. That's an example. Then you have a country, listing country. In my case, it's United States, but here you have examples of countries that you can input. Then I leave other fields blank. I'm sorry. Like, for example, sector, industry, I'm not interested in that. Market cap, more than, and this one is interesting. I'm putting the market cap more than. This is the billion, 1 billion. So it's the mid cap shares. If you're interested in searching something among larger caps, you can put market cap more than 10 billion. And it will show you larger shares. If you want to search something among smaller caps, you can put market cap more than or market cap lower than 1 billion, and it will find you stocks from the smaller cap. But in our case, let's work with stocks in the mid cap range. Then I have these fields I leave blank, and then I have one, it's a beta lower than. So beta is the systematic risk. It shows you your stocks risk in comparison to the stock market. In our case, it's S&P 500 index. We're comparing to the index. Usually when analysts say index, when analysts say market, they mean index. In our case, it's S&P 500 because we're extracting for the US exchange. And beta, for example, if you put beta 3 or 2, it means that your stock will be 2 times more volatile as the S&P 500. So if it is gaining 2%, your stock will gain 4%. If it's falling 2%, it can fall 4%. Of course, not always, but historically, this analyzes historical price movements and then compares your stock's volatility to the S&P's volatility. That's how it's calculated. And I put beta lower than 1, which means we are searching for less volatile stocks. And then the last parameter is actively trading. Is the stock is actively trading? You can put true. And then hit enter, and it is highlighting you those results. These are the shares that it extracted based on our search criteria. As you can see, it's a beta. You can sort them based on beta and pick stock with the smallest beta. As you can see, it's a last price, the exchange. If it's an ETF, it will write true, but in this case not, because this screener is extracting stocks and ETFs as well. So once you have this list, let's choose less volatile stock for risk-averse investor. Let's say we are interested in Procter & Gamble share, for example, with beta 0.414. And this is the stock ticker. So simply copy the stock ticker PNG. And the next step would be to input the stock ticker. I prepared the small table over here. I paste it right here, and it is calculating the data. I will explain how to fill in this table right now. So we need to extract the earnings per share data for the stock using the formula FMP historical earnings calendar, and then the B2 and 30. 30 is the number of the observation. It is extracting 30 because, as you notice, the EPS data, or earnings per share, which is calculated as net income divided by number of shares outstanding, it is very important parameter for investors. And this data published quarterly, and we are interested in obtaining 6, 7, or 7-year data. That's why I put the period 30 here, because we extract for each quarter. And then B2 is the number of our ticker. It's a B2, as you can see, PNG. That's the stock ticker. Then I hit the enter, and it is extracting me the EPS data. As you can see, here is the EPS actual and EPS estimated. Those fields are blank because companies still didn't report yet. These years are still to come, and these are the most recent years. We will be taking those numbers for our analysis. And we extract EPS data to calculate the EPS growth over the past 5 years. That's a simple formula. We're just taking the percentage change. So we're taking the last known EPS that company published, earnings per share, the actual EPS, minus the EPS for the year 2019, which was 125, and divided by 125. You can take even this data, the first year in our observation, and divided by minus first year and divided by first year. But in this example, I'm taking 125 to calculate the percentage change over our analyzed period. So it shows 54.40%, which is the good number. Generally, the number above 15 would be a good indication. I'm taking the average on the industry, and number above 15 would be a good indication of interesting share. Then, of course, beta below 1, our PG satisfies this condition because, as you know, we have beta 0.414. It is less risky share for risk-averse investors. Okay, the market cap, it's written depends. Usually now the larger caps are undervalued, majority of them, so you can try searching for smaller caps, but smaller caps tend to be more volatile. They tend to trade with gaps or with higher price differences. Even within one trading day, it can be good for intraday investors or shorter term investors, but for mid-term ideas, it's better to search something among the mid-cap or larger caps. And price to earnings ratio, it is fetched, as you can see, AD10. It is fetched from in here. price to earnings ratio we needed for our PEG calculation. So the price earnings ratio over here, we're taking the B2 as, again, this is the stock ticker. We're using the FMP formula, FMP ratios TTM. TTM stands for trailing 12 months. And then the name of the ratio, price earnings, capital R ratio, TTM. These three letters are capital. You should write it because if you don't write it, it will fetch a lot of other ratios, but we don't need them for now. That's why I only put the stock ticker and the name of the ratio like this. The formula should look like this. Then you hit enter and you get the price to earnings ratio trailing 12 months for our share. We extracted to calculate the PEG ratio. PEG ratio should be below 1. If it's below 1, it indicates that the stock is undervalued currently. So the formula for the PEG ratio is the price earnings ratio that we extracted divided by EPS growth rate that we also extracted. So it is 52 in our case. As you can see, that's the simple formula. We simply take the ratio and divide it by the EPS growth rate and we get the 52. In our case, the stock is overvalued and you should try finding other stocks that look more attractive with the PEG ratio below 1. You can try searching in this list. Let's go with another selection. Let's say I've seen the stock with the low beta as well. Let's try this share, for example. Yeah, it has a negative number. So let's try another share with, we're trying to find low PEG ratio. For example, let's try Johnson & Johnson. Just copy the stock ticker. Yeah, it also has higher ratio. Then you can change the screener parameters and put lower than over here, lower than 1 billion. Remove this one. And now it will extract you stocks with market cap lower than 1 billion. As you can see, higher beta, but you can still search for something with smaller beta. Let's say this share. It shows its market cap. Just copy it and paste into our table. Oh, it's not fetching the data. Let's see why. Yeah, because it doesn't have the EPS history that long. In this case, we can make a few corrections. So it's F33, like this. Yes, it has very small PEG ratio, which means that the share can be undervalued. Now the next step would be to take the share and calculate it using the DCF, discounted cash flow model, to calculate the stock target price. Or you can also use the financial modeling prep endpoint for extracting stock target prices for this share. Let me show you how you can do that. I will send a link to the playground in the description. And then in the search, you input target. As you can see, the target price. And then input the stock ticker. We don't have a lot of coverage by analysts, but you can see the adjusted target price is 4.2, and you can see the target price when it was posted. Here it was almost fairly valued. Here it was slightly undervalued, overvalued, and currently it is slightly undervalued based on the investment analyst target price from UBS. This analyst was from UBS and it calculated the target price of 3.82 when posted. So let's see the current price of the share. 312. 42, 312. So it's 4, 2, and 312 is the current market price. And you can just calculate the percentage difference. You can calculate it like that, or using the natural logarithm if you want. It has 33% growth potential, but of course you should also manually calculate it using the DCF model. I will put the link to the video. You can watch the video and understand how you can calculate it. You do it to understand what can be the free cash flow to better react for the changes. For example, if you build the model and calculate the DCF manually, you will be able to understand how companies updated financials can affect the stock target price and then the market price. For example, you calculated the stock target price yourself manually using the DCF model, and then there is a forecast of the free cash flow. You can forecast it, and if the company is posting free cash flow lower than expected and lower than your expectations, then you can correct the model and see how it will affect your calculated target price. And if it will decline, you can make an assumptions that the stock market price would also decline, because the market price reacts usually directly to the target prices. That's why you need to calculate it manually. That's how you can do that. Of course, you can keep searching. You can, for example, expand this screener and substitute this number. Let's put it here. But instead of 10, you can try searching for, let's say, 30, and it will extract you 30 different stocks. Then from this list, these are larger cap stocks. From this list, you can try finding stocks that satisfy your search criteria. For example, AT&T. Let's see this company as well. No, it has negative PEG ratio, but I think you understood the assignment. You should keep searching. You have screener and you should keep searching until you find stock with a lower PEG ratio, high EPS rate, above 15%, low beta, and then you can start your research from here. If it satisfies our search criteria, then you can undertake equity valuation, calculate the stock target price, and if you like the company, you can consider buying the share. So I hope my video was useful. Thank you very much for watching.